Well, good morning everyone and welcome to today's webinar brought to you by Antipodes. I'm Matt Dell from Pinnacle Investment Management, the distribution and minority equity partner for Antipodes. Today's presentation is being delivered to you by Antipodes Deputy Portfolio Manager, Andrew Baud. Andrew is responsible for coverage of the global consumer sector. Prior to joining Antipodes Partners in 2015, he was an investment analyst at Platinum Asset Management for 10 years, where he covered a diverse range of sectors and geographies. More recently, he was senior investment analyst covering North American equities after he relocated to New York back in 2013. Today we're talking about diagnosing value in healthcare, a sector which has lagged performance for some time, but has created some extreme valuations that have created some investing opportunities. And our feature stock today is going to be Gilead Sciences. Now, before I hand over to Bo, please note that you can ask questions as we go along by clicking on the Questions tab on your screen. You can also provide feedback to us on the presentation to help us keep these webinars relevant to you. So now I'd like to hand you over to Andrew Baud to take us through the presentation.
Great. Thanks, Matt. Hi, everyone. Welcome to Antipodes' presentation on diagnosing value in global healthcare markets. Go to slide 2, just for a quick introduction to any new listeners out there. Antipodes Partners is a global pragmatic value manager that applies a holistic approach combining cyclical, structural and macro considerations. We marry the quantitative-based tools and processes with the qualitative insight that comes from a diverse and experienced global investment team. Portfolio construction is core to our process because managing money is not just about picking good stocks. It's also about managing overall risk in the portfolio. We manage just 3 investment strategies of global long short, global long only and Asia long short with a performance culture that's aligned with clients' interests. And ultimately, we're aspiring to generate absolute returns in excess of the benchmark over the investment cycle at below market levels of risk. On slide 3 is our philosophy. And essentially, if you manage risk well, returns will follow. I actually recently came across this quote from Benjamin Graham, who said, "The essence of investment management is the management of risks, not the management of returns." So I'm glad we're on the same page with someone like that. Before any investment is debated, each analyst must always address these 3 risk factors. Firstly, margin of safety, or the price you pay. The stock should generate a minimum of 15% absolute annual return and also be greater than 10% relative to its sector. Secondly, strong business resilience. You increase resilience with the more ways you have to win. It's not good enough just relying on 1 or 2 reasons supporting an investment case. They might well turn out to be just 1 or 2 points of failure. And alternatively, if the investment case to short is presented, then it needs to be underwritten by multiple ways to lose. Thirdly, manage portfolio risk. We construct the portfolio by actively monitoring the build-up of known correlated risk and limiting this via clusters or exposures of no greater than 15%. This discipline also helps to limit the associated unknown correlated risk, which unfortunately only ever becomes apparent after the event. On to slide 4, I think every presentation needs a little comic relief. So on this page or this slide, the message here is that anyone with asset ownership, whether it be shares, property, bonds or even Bitcoin, has been enjoying a wild ride on board the low interest party bus for a long time now. And the question is, how sustainable is it? If we look at slide 5, spot the difference. As our headline reads, this chart suggests bonds are discounting a steep deceleration in growth of inflation. But the evidence, as per the bar charts, for actual growth across the US, the Eurozone and Japan is suggesting otherwise. For the first time in a long time, we're finally seeing a shift now in behaviour with interest rates around the world starting to appreciate, with the US leading the way. So in a world where real and nominal GDP growth rates are actually pretty good, the historical relationship alone suggests there is upward pressure on interest rates, that's the black dots on the chart, to rise to more normalised levels. And whilst we're not making a case for a return of secular inflation, there is certainly evidence of more cyclical-based inflation that we see emerging across economies. On to slide 6. Here we're showing some of the perverse outcomes in markets that have sprouted from the extended lower for longer interest rate environment. And here our quant team has isolated 2 equity factors of growth and multiple dispersion to focus on. Each factor calculation compares the level of valuation dispersion between top and bottom quintiles today versus the past 30 years as per Z-scores or standard deviations. What stands out is growth has hit a new peak, and investors continue to crowd into stocks with high growth characteristics. And it's not just happening in the technology sector. It's a similar pattern we're observing across all sectors. So generally, those overcrowded growth stocks should be avoided, or they can be potentially shorted as well. On the flip side, as per the multiple dispersion factor line, which considers a range of valuation metrics, we are not lacking good opportunities, both long and short, as the expensive stocks get more expensive and the cheap get relatively cheaper. On to slide 9 is another one of our quantitative tools. This time we're applying a heat map across global equity markets, divided into regions and sectors. It's never good enough to just look at the world on a regional basis. You must always drill down to the sector level for a better understanding of relative valuations. So the map shows today's valuation as per enterprise value to sales relative to the world and compared to its 22-year trend. In general, based on a Z-score of standard deviation, light blue to dark blue is cheaper, whilst yellow to red is on the more expensive side compared to the past. As indicated here, what's looking cheap is financials, energy, communications and domestic cyclicals across the board, while staples, technology, materials, mining and industrials are showing up as being relatively more expensive. If you look at healthcare, well, healthcare is looking a little bit more patchy, except for developed Asia, which looks very expensive on its own. Now, given today's webinar is focused on healthcare, why don't we do a deeper dive now into the sub-segments of healthcare. On to slide 8. Here we've done another heat map. Generally for healthcare only, you can see the world has become relatively cheaper, except for the medical specialty sector in developed regions, which includes products like medical tools, devices, lab supplies, that kind of thing. The standout here is the derating or relative cheapness, I think, of major pharmaceuticals across all regions except, again, for developed Asia, which is basically Japan and Korea. Before we provide the investment case on a major pharmaceutical or drug company that we think represents great value, let's first discuss some of the secular headwinds and issues contributing to the sector derating we just observed. So it's on to slide 9 with 4 charts here. And the charts lean on history going back almost 60 years to help put rising healthcare costs into context. I mean, it reminds me of the proverbial boiling frog. As citizens of developed nations with steadily rising healthcare costs, we are slowly being cooked alive. And I think anyone paying annual health insurance premiums knows what that feeling is like. This expanding cost of healthcare is clearly not sustainable. In 2016, you can see healthcare reached 18% of US GDP, and that's almost double that of any other developed country. In response, governments are now starting to wake up and politicise the issues, as heard recently from Hillary Clinton and President Trump. But I think probably more importantly, corporations now in the US, with huge employee health insurance liabilities, are looking to develop their own solutions with or without government help. For example, earlier this year you saw Amazon, Berkshire Hathaway, which is the entity of Buffett, and JP Morgan announced they would form an independent healthcare company for their own employees. When you combine the 3 companies, they have around 750,000 US-based employees between them. And while detail is still light on the policies they're going to introduce or the processes, no doubt to assume that companies will use their weight to negotiate better prices and services for themselves and employees. And if they can make a success of that, assume others are going to follow. And potentially they could open it up to others to join their platform as well. Now, talk or actions, whether they be from government or the private sector, That's putting the spotlight on the healthcare supply chain and in turn making the incumbents and their investors very nervous. Key US incumbents in the healthcare include hospitals, pharmacy benefit managers, physicians and clinics, health insurers, and of course the drug companies. Despite the negative publicity drug companies are attracting, since 2000 they've actually remained at 10% of the total expenditure pie, with hospitals remaining the largest rent collectors at just over 30%, ahead of doctors and clinics with 20%, as per the chart on the bottom left-hand corner. The bottom right chart shows that it hasn't been easy for drug companies either, as competitive pressure has been relentless from generic alternatives. So today in the US, it's now 90% of all new prescriptions for a chronic condition utilise a generic drug. In response, the drug companies have been pivoting from developing low-cost, high-volume drugs to high-cost, low-volume drugs that treat rare diseases. Which try to give an indication of this if you move now to slide 10, where this shift is demonstrated. The companies with more unique treatments, in effect, have greater pricing power with the payers, as indicated by the final rebates being much lower. And that makes sense because if you provide a treatment for a disease that is currently underserved, then pent-up demand should result in more resilient revenues. And on slide 11, we've taken a look at some of the research and development trends of big pharma and biotechs. The big pharma has been facing patent cliffs and costly gestation periods to commercialise research and development efforts, which usually takes over a decade to complete. And because of that, there's been a growing trend among large pharma companies to buy rather than invest and grow organically. But you can see here the long-term consequences of that trend on the top chart becomes apparent when we study these charts. Acquisitions end up capitalising a lot of goodwill on the balance sheet, and if they don't deliver on expectations, then long-term returns will decline, as shown by the falling rates of return on capital, which should be a warning or concern for shareholders. But at least if you refer to the second chart, the bottom one, at least it's encouraging to see when comparing biotechs relative to large pharma that rising relative R&D spending is getting rewarded by the market with rising relative EV to sales valuation multiples. So the market still appreciates good R&D. Now let's move on to slide 12, where we introduce our pharma feature stock, which of course is Gilead Sciences. We've actually held Gilead in our top 10 since inception, and we recently increased its weighting to become now our largest holding as of last month, I think it was. The top right-hand chart, illustrates the share price fall and the valuation derating Gilead has suffered since its peak in 2014, 2015. And the market's been extrapolating the industry concerns we mentioned earlier and a faster than expected decline rate in its hepatitis C, or otherwise known as HCV franchise. But we think the stock is set to recover from such concerns. And there are multiple ways to win for Gilead Sciences. The bottom right chart shows the sales contribution of Gilead's leading drug franchises, which have been HCV, which was the Hep C, and HIV. And I admit we had underestimated the steepness of the sales decline for HCV, which suffered earlier than expected price competition and slower than expected pool of patients in the US presenting themselves for treatment. And now the pool of available patients is critical in this case because HCV is actually cured over a 6-week treatment process. Unlike most drug schedules, Gilead therefore cannot rely on existing patients to keep coming back for repeat purchases. But we think we're now through the worst of the decline, and we're expecting HCV earnings to stabilise and then to no longer be a negative drag on the business the way it has in the last couple of years. The other way to win is through HIV treatment, which remains a core franchise of Gilead, with nearly 80% market share for treatment programs in the US and around 50% internationally. US-based government funding is actually virtually secure, courtesy of unique public funding availability established under the 1990 Ryan White Comprehensive AIDS Resource Emergency Act. No government, no US government wants to risk high rates of HIV. And the unfortunate nature of the disease to evolve and develop resistance over time also helps Gilead's leading innovation to sustain its competitive advantage. Also, Gilead's drug pipeline is looking very promising now, with commercialisation likely in the next year or two for inflammatory, and for that you can think of Crohn's disease and rheumatoid arthritis, and the other is liver disease, which happens to be a strength of Gilead given its existing HCV franchise. And finally, on the multiple ways to win, Gilead has a good and actually a patient track record of creating value from acquisitions. The purchase of Pharmaset for $11 billion for HCV in 2011 was a great example. Last year, Gilead paid $12 billion for a company called Kite Pharma, which has developed unique technology for late-stage personalised CAR-T cancer treatment. The potential of this is pretty exciting, and we explain the process a little further on slide 13, the next slide. But before getting there, let's just finish up first with the high margin of safety provided by Gilead. We think the stock is worth north of $90 a share, and we get there by rewarding the strong and growing HIV franchise with an earnings multiple of about 15 times we think is fair, which equates to about $70 per share. We then put the HCV franchise, which is now in run-off mode, on roughly 10 times or $20 per share. And that's before attributing any value for the increasingly exciting drug pipeline to come, which at this stage we think could be worth in excess of $10 a share. Now on to slide 13. This is a very simplified version of that CAR-T cell treatment process that I just mentioned before that Gilead has acquired. Now, unfortunately, most of us in our lifetime will be in contact with cancer either directly or indirectly through friends or family. So we think the CAR-T technology is both fascinating to understand and potentially very valuable for Gilead shareholders. To explain the process, which is a great example of the personalisation trend of drug treatments, the patient goes to hospital and first we must extract blood from the cancer patient in a similar way to you extract, or you give a regular blood donation. Then after extraction, the blood is then passed through a machine that can identify and collect an immune cell known as T cell. These are commonly referred to as the workhorses of the immune system, which normally seek out and destroy infected cells. Next, the genome, which is basically DNA code of the collected T cell, are genetically modified so they can recognise a protein on the surface of the patient's cancerous white blood cells. The modified CAR-T cells then get grown and multiplied into a huge army over a few days before being ingested back into the patient to take up the fight via a blood transfusion. The cells circulate through the body until they encounter the cancerous white blood cells with the corresponding protein they're looking for and take them out. It's quite an amazing technology, and so far it's proving to be very effective. That brings us to the end of this section on healthcare, onto slide 14. And so just to summarise, we think investors are overpaying for growth, so beware the crowding. Focus on the next crop of winners in neglected areas as per the blue shaded areas identified on our heat maps earlier. And multiple evaluation dispersion is high, which is presenting numerous global asymmetrical opportunities on both the long and short side. And with regards to performance, since inception from July 2015, we've managed to deliver outperformance across all three strategies and most importantly at below market levels of risk. And for example, the global long-short average net equity exposure has been 59% today. So with that, thank you for listening in, and I'll pass it back to Matt to finish now.
Okay, so let's take some questions, and Bo, I've got one here. Are you actually short anything in healthcare?
Thanks, Matt. We have a small short exposure to a hospital operator, which we think is being priced highly, particularly with some high operational risks that it's exposed to. But overall, in the healthcare space, no, there's not much short exposure at this point.
Another question here regarding President Trump. What did you make of Donald Trump's plan announced last week on healthcare?
Yeah, it was announced over the weekend. I think it was a big announcement that many people were looking forward to, because Trump had been promising a lot, particularly on his campaign trail back in 2016, about how he was going to get stuck into, drug prices in particular and other issues within healthcare to try and control some of those costs that I mentioned earlier, the rising costs. He had talked about finding a free market solution to bring down drug prices, but with what he presented, there wasn't really much in there that we can see is going to make much difference. The big concern, and it still may arise again because we're going into these midterm elections in the US around October, November. The big concern, this issue may get raised again, particularly from the Democrats, now that it doesn't look like Trump is doing too much. There's been a push for the US to try and revert to a negotiating system like Medicare in Australia. And that's where you actually have an independent body assigned by the government that recommends and does the negotiations with the drug companies that allows access to drugs, and more importantly, at what price that access should be allowed. The US doesn't have this system. And without changing it, that's why you saw a bit of a small rally last week, across the healthcare sector. But again, I'd be wary of more political rhetoric that'll be getting wound up for these midterm elections.
So I've got a question here about, another question about the US. Do you expect the tight US labour market to continue to drive wage price inflation and the 10-year bond higher, meaning that Antipodes will continue to have a low net exposure to the US?
There's a few pieces to that. Wages in the US, they're actually not yet accelerating or driving higher. That's kind of been the laggard within the inflation piece. I think many are waiting to see if wage inflation, I think it's about 2.6, 2.7. If that picks up and starts moving beyond 3%, then you'd expect higher inflation. So there's lots of anecdotal evidence that wage inflation is around. We're hearing it particularly from the retail level, which obviously employs a lot of people in the US. So there's pressures there, and unemployment is low. But not yet seeing that wage inflation, but potentially it could come. In the meantime, you are seeing the 10-year rates move up. They exceed 3%. Calm down again. I'm not great at making the big macro calls, but there is underlying pressure around to suggest those rates should go up. What was the final point was the US net?
Yeah, is it likely that we'll continue to have a net exposure to the US as we have done since inception?
Importantly on that, yes, we do have a low net, but I always like to make the point that we actually have, a decent amount of long exposure to the US. That low net comes about more because there's far greater shorting opportunities within the US, and we don't see that. I don't see that changing anytime. So I would expect that net figure will likely remain around. I think it's between 5 or 10%. It has been just.
And look, related to that, though, is a question here regarding the fund's gross exposure. There's a question here, has it ever been above 100% for any sustained period? For the long-short fund, obviously. The answer is no.
Yeah, I don't think so. It normally sits around that 95 level. It may have in the past, but it wouldn't have been there for too long, I don't think. Yes, I don't think so. That's the short answer.
Okay, well look, I think that's, was there any, no, there's no further questions there, I don't think. Sorry, there is a question there about the slides being provided to viewers of the session. They are available to you on Bright Talk. At the end of the session, you can go back and review the presentation at any time and listen to it again if you wish. So look, that concludes today's webinar. Please don't forget to rate the session and provide any feedback that you might have. If you would like further information, please visit the Antipodes website at antipodespartners.com, or as I said before, contact a member of the Pinnacle distribution team. And you can see there on the slide, on the screen now, the necessary disclaimers. So thanks again for joining us today, and enjoy the rest of your day.